Hello and welcome. My name is Kyle, and this is going to be a video tutorial that goes over problem S16-13, I believe it is, from the Pearson textbook. Had to deep into my memory bank to remember what problem it is that I have set up for us. But here we go. I've got the problem already for us to go in Excel here. So we have Heinz Limited, and they own a vast amount of corporate bonds. And let's suppose that Heinz decides now to purchase $1 million worth of Kuzawa Corporation bonds on January 2nd, 2020 at a price of 97. So they own a whole bunch of bonds and now they're buying more. The Kuzawa bonds pay interest at an annual rate of 6%. So this is going to be the coupon rate on the bond. And they mature on December 31st, 2024. So we can calculate the term here. We've got all of 2020, 21, 22, 23, and 24. So there's a 5-year term on this bond. Now let's see what we need to do. So that we've got basically everything that is going to be relevant for us underlined or highlighted in the problem in the question stem. So question number 1 is, how much did Heinz pay to purchase the bond? How much will Heinz collect when the bond investment matures? So this is a home run of a question for us. We know it tells us they paid at a price of 97. So they bought this bond at a discount. Now let's remember why bonds get purchased at either a premium or a discount. It's because bond prices are dictated by the market interest rate. So when interest rates go up, bond prices go down. There's an inverse relationship between bond price and interest rates. Alternatively, if interest rates go down, bond prices go up, right? If I'm an investor and I want to purchase this Kuzawa bond that pays 6% interest, and the market interest rate is actually higher, it's maybe 6.5%, I'm not going to actually buy this Kuzawa bond because I can get a better interest rate somewhere else. So Kuzawa has to make this more attractive to me by lowering the price of their bond so that my yield on the bond would be in fact greater than 6%, even though 6% is the stated rate in the coupon or a stated rate in the bond contract. All right, so that's why there's that inverse relationship. So the answer to question 1, requirement number 1 is, well, how much did they pay? They paid a price of 97. So 97% of face value is what they paid. And the face value, sometimes called maturity value, in this problem, it was stated at $1 million. So the purchase price was $970,000. How much will Heinz collect when the bond matures? The maturity value of the bond is always going to be the face value. So Heinz will collect $1 million at maturity, which is on December 31st, 2024. Okay, so this is requirement number 1. Requirement number 2, let's see, how much cash interest will Heinz receive each year from Kuzawa Corporation? The interest payment is always dictated by what is stated in the bond contract. What is stated in the bond contract is the face value, the interest rate, and presumably bonds are typically paid on a interest on a semi-annual basis. The bond pays cash at the annual rate of 6% and matures on, and it's asking for us for how much each year. It's not asking for us for the semi-annual payment. It's asking us for the annual payment of interest. So that's going to just simply be the face value multiplied by the coupon rate in the contract. I have that denoted as I over here. The face value of this contract is $1 million. The coupon rate is 6%, which means that I think that's 60,000. That means that annually they're going to get $60,000 in interest as revenue as a cash payment, I'm sorry, not as revenue, as a cash payment per year. So this is the answer to requirement 2, is that they get cash annual cash payment. Okay, now what do we need for requirement 3? Let's see. Compute Heinz's annual interest revenue on this bond. Use the straight line method to amortize the discount on the investment. Right, well, this organization bought the bond at a discount, right? They paid a price of $970,000, but they're collecting interest of $60,000, which reflects a 6% interest at the maturity value. But we know, because this bond was issued at a discount, that the market rate must have been higher, which means that the revenue they should be receiving, the revenue they're going to recognize, I'm sorry, is going to be a reflection of the market rate. So what they need to do is they actually, in interest annually, the interest revenue is going to be a combination of the cash payment, which was 60,000, plus the amortized discount. Now the discount on this bond, if we look at this, they purchased it for 970,000. The overall face value of it is $1 million. So we have a discount of 30,000. So the face value was 1 million. We purchased this for 970,000, which means that the discount on the bond was 30,000. This discount gets amortized over the term of the bond. This, if we recall, and I'm glad I did this right up front, was a 5-year term. This means that this $30,000 is going to be amortized equally over the 5 years, because they're using the straight line method, I believe, of amortization. Now, this is just asking us to compute the interest revenue. I'm going to go beyond the problem. I think it's always good to go beyond the problem. I'm going to do the journal entries for this as well. And I'll do it for requirement 1 and requirement 3. But before we get to the journal entries, let's just look at this. They have a $30,000 discount that's going to be amortized equally over the 5 years. So discount amortization is going to be the $30,000, the total amount of the discount, over the total term. This is going to be the amount that gets amortized annually. Now, I believe this is $6,000, and I should double check that. Yeah, okay. So this is the amount that gets amortized annually, which means that the total, this amount will be added as interest revenue to the investor. So the interest revenue is a combination of the cash payment plus the amount of the discount that gets amortized every year. So the final answer to requirement number 3 is 66,000. This is the annual interest revenue. But now let's look at journal entries. Let's look at these journal entries. In requirement 1, it asked us, what did they pay? Well, what they paid was 970,000. So if we were to do a journal entry for it, I like to always just think about what is easy. What is easy is the recognition that they paid $970,000 for something. So what is easy is knowing that you have to do a credit to cash for $970,000. So cash is certainly going to go down. So we can start there, that cash is going to be decreased by 970. What they got was an investment in a bond. So investment in bond for 970. This bond right now, as of the date of this purchase, is being recognized on the balance sheet at its current market value, right? If they bought it for $970,000, that's the actual market value of the bond as of that date. And I don't know what date it was that they bought it, so I don't know. January 2nd, 2020. So that's the date of the journal entry, investment in bond, and then they bought that bond with cash. So this investment in bond account is an asset because they are the investor. We previously looked at bonds, but from the issuer perspective, and when it's the issuer, it's a liability, but in this case, this is the purchaser of the bond, so it is an asset for them. But you'll notice here, the investment in bond is carrying at $970,000. What happens here is that annually, they're going to collect interest. And when they collect interest, of course, cash is going up. And let me just copy and paste my journal entry template down here towards number 3. When they collect interest, cash is going to go up. Cash is going to go up by the cash payment, which is $60,000. We previously had calculated that. Cash is going up because they're receiving interest revenue of 60,000, not 600, 60. Okay, but we have this whole amortized discount of 6,000. This happens annually. So what we need to do as well is do a journal entry to amortize that discount. When we do that journal entry, and this should be not January 2nd, 2020, so we're doing annual interest payments. So I'm going to do December 31st, 2020. So this is the first year. What we're going to do as well, the same day, is amortize that discount. And I'm going to do that by debiting the investment in bonds account. So I'm going to increase the value of the bond by 6,000. And I'm going to recognize interest revenue of 6,000 on the bond. So that we can see here through these two journal entries, the annual interest revenue that we're going to collect, it's going to increase income on our income statement, is going to be 66,000. But I just debited this investment in bonds account. So if I were to post these two into a T account, I'm just going to create a chicken scratch T account here. The original purchase was 970. And then the year one, right, this 970 debited, this is an asset, remember. And then in year one, we just increased the carrying amount of this bond by $6,000. And this is the year one. In fact, we're going to do this journal entry every year. Actually, we're going to do both of these every year. But only the second one is going to increase the carrying value of the bond. Right? We're debiting this investment in bonds account. So we're going to debit this every year. So this was year one, year two, year three, year four, year five. So at the end of the fifth year, the carrying amount of the bond is going to match that face value, $1 million. This is the amount of cash that you're going to receive from the investee at the end of the bond term. So the asset value at the end of the term needs to match the face value at the end of the term. Okay, so this was S16-13. I hope that you found this tutorial useful. If there's anything that you need from me or anybody at Conestoga, please feel free to let me know. Okay, I hope you have a good day. And maybe I should just pause down here so you can take a look at the overall solution one more time, or the journal entry one more time. Okay, thank you so much. Take care.